All right, market profile, part 2. What we're going to look at in this section is a movement away from the sort of general principle in terms of understanding auctioning, understanding how balance is created, how markets kind of move from balance to imbalance and back. That's kind of the more generalized. What we now want to start looking at is some of the more specific pieces of information that you can gather from looking at a profile. So when you look at a profile, what are the bits of information you can pick up? What story does that tell you? So we're going to cover these things. So we're going to start off looking at value area, what I call value area quality. So the judgment of how well people are actually accepting price where it is. We're then going to move on and have a look at completions of moves, looking at what you call a tail or ledge or bad highs, how to view these things, how also to trade these things. So how are you actually going to take that on as a trade? The thing that often I feel is taught in a lot of profile stuff, and you find with a lot of profile, is after the fact it's very clear. But what you've got to look at is, okay, well, if I'm seeing this situation develop, how do I make this a trade? How am I going to go about playing for this? Because a lot of the references tell you what should happen or what needs to happen is often a phrase that you hear. Yeah, the market needs to repair this, the market needs to test that level. And you've then got to take that, because you can show it afterwards and say, look, it needed to do this, and look, it did it. You've then got to kind of reverse that back and say, okay, well, if it needs to do it, how does it do it? What's got to happen and how can I be involved in this? So that's the thing that I want to try and focus on in this section. So to start off with then, talking about what needs to happen, we're going to look at value area quality. Right, with value areas, the simple trade, I think that when people learn profile on a very basic level, they learn the reference points of a profile. They learn what the high of the value area high is, the value area low, the VPOC. And they assume that there's going to be reaction from each of these as if they were a level. And you will get situations where that works. But that's not really good enough, because with a profile, you will have a value area high, value area low, and a profile every single day. If you trade each of those as a level every single day, I'm going to have a very, very strong guess, and I've not done the stats on this, that you will not end up making money. Too many of these will not work. And so you've then got to look at, well, what's the situation where you can say to yourself, the value area extremes are going to create a reaction, or the value area extremes can be completely ignored and can be actually viewed as points to trade through. And this all comes down to value area quality. It's a question of how much acceptance is there. Now, if people are very, very much in agreement as to where value is, the market will accept in a nice tight range, something like this. You see, particularly in terms of time, huge amount of acceptance. It's very, very clear bell shape after an initial move up, normal variation type day. We'll talk about day types in the coming sections. So very, very nicely balanced. And equally again here, reasonably well balanced. So these are two value areas that I would suggest are reasonably good quality. Whereas where you have wide value areas, stretched out value areas with multiple kind of anomalous high-low volumes within them, so no bell curve, this suggests a lack of acceptance. And in that sense, the market needs to repair this. We need to work out where exactly value is, which brings with it its own implications. Small value areas, the simple way of looking at a small value area is the market will trade through it easily, just like this. You see here, that's where value is. If we look at the first profile, profile 1, profile 2, look at where the volume is on profile 2. There is no volume inside the previous day's value, because the market's already traded here. We've accepted trade in this area. There's no need to trade there any further. Everyone's happy. So if the market is going to move, if the market moves away from this area, we will move quickly away from it, because as people change their minds. The only situation where the market will stay within a very, very well accepted value area is if you still have the same degree of acceptance the next day, typically opening inside, and you will then do the same thing again. But if you approach a very well traded area where people had accepted value and then moved away from it, the assumption is that this accepted value that was there previously doesn't need time traded again, because that was accepted and then proved wrong. So people aren't going to come and accept value back in the same place. The market will sweep through these areas. So quite simply, small value areas can be deemed as certainly irrelevant from the point of view of reaction to reference points, i.e. reaction to highs and lows of value, and can actually be looked more at as something to sweep through, trade through nice and easy. Whereas a large value area, they don't have value well established. And so therefore, we need time to work out where value is. I'll give a couple of examples which makes this a little bit clearer in a moment, but the simple way of thinking about it is if no one knows where value is, As a seller, you're going to try and sell at the highest available prices. As a buyer, you're going to try and buy at the lowest available prices. Therefore, you will stay within value, but closer to the extremes of value. And for this reason, markets will react from the edges of value when you have a broken or very wide, unclear value area where you don't have that degree of acceptance. It shows an uncertain market. Nobody's sure where value is, and so in trying to find value, people start out at the best prices that they can get as a seller or as a buyer, and then they move inwards to try and actually get filled, and this then naturally creates value in the middle. So that's what you're looking for with these much wider ones. You need more time spent inside them, reactions to edges. Small value areas won't spend a great deal of time inside them, and you will not get reactions to edges. Let's have a quick look at a little sequence of different value areas moving through time here. And as we know, the market will seek to balance. And so what you can have is also trade within the day within a value area and within parts of value. So take, for example, we'll start off on the left-hand side and move through sequentially. Wide broken value area here. You've got almost a double distribution. We'll talk about this day types coming up, so don't worry if you're not sure what double distribution is, but quite simply, you put some value here, we've then put some value lower. So where's the area that there is no value? In the middle. We'll talk about low volume areas, what I call caves, in a little while. But what you'll get in seeking to work out where value is, sellers are going to try and sell up here from this day, and they're going to try and buy down here. And this then creates trade in the middle. Even though we have deviated at one point higher and back, the market ultimately settles in the middle of this area. And so you will then establish value where there was previously no value. On the back of that, we have another day that trades higher and establishes value. Good acceptance of value at the top of the last couple of days range. So there we've got clear acceptance followed by a late in the day sell-off. So the J print goes all the way down to create a new low. This is a news-induced move. Looking at the timing of it, this is likely something like the Fed rate decision, a Fed minutes decision comes late in the day in the European market, and this moves us a long way from value. So you've now got a market that, one, can gravitate back to value, and two, has clearly accepted value up here. This is giving you a bullish bias ultimately. We then go some way to put in value lower and put in very little trade above it. And as a result, we use the top of this area, start to build some value filling this low volume area out, which is what happens over here. And the market then moves slightly higher. Next up comes the approach of the tight value area. So what we end up with here, we open up here, we trade back to where we previously had a decent amount of volume. You get responsive trade, people buy from the top of value, and then you end up with what you call a sweep. You look at where the volume's established on this day, we get very, very little trade between 42 and 26. You go and look over here, the bottom of value comes in at 24, the top of value comes in at 39. And so you get very, very little trade in between that. Basically, the market sweeps through. Where's the lowest volume? Matches perfectly with where the highest volume is there. People have accepted value up here. This is giving you the bullish bias. On the way back up there, those who feel that the market is bullish are going to be very happy to buy in this area. Those who were short because of the sell-off are now in trouble. We're back in an area where the market showed it was bullish and showed that there was some acceptance, and now you're seeing a willingness to buy again. This drives people out of position, and this is what then drives the market further towards the upside. So that's how to kind of view different value areas. You're going to spend more time inside value where you get these wide areas. When you look here, you only get that little area of trade outside of the wide value. Whereas small value areas, we will not spend a great deal of time in them at all. Essentially, the P prints take you into and through the entirety of that small value area. To show you this happening in sequence throughout the day, rather than just a sequence of this profile, match this one, match this one, match this one. One way of looking at it is profiles should almost fit together, and the aim is to seek value over a longer period of time. So here what you've got is a situation where, again, you have a pretty unbalanced value area, reasonably wide. There's no real balancing out here. There's no real sort of bell-shaped curve. And that's caused by this movement here. We get some volume comes in, this is a move in the pound. Bit of volume drives the market up, and then we come back off. And this is the thing, we're not establishing value, say, much higher after a directional move. This move doesn't sustain itself, and so we end up pulling back quite significantly, which is why you end up with this sort of very, very wide value area. The market is traded up and down in quite a wide range. As a result, the market needs to work out where value is. We end up in a situation where we stay entirely within value, bar one small dip below 37, that is this little tail just here. Apart from that, everything stays pretty much entirely within the previous day's value and establishes a very, very tight value area between these two red lines. So what you can expect and what you can be looking for on a day like this is you can go into it with a view that anything towards the bottom of value and anything towards the top of value, if it presents you with a reversal opportunity, is going to be a prime chance to start to play for a very balanced looking day. And we end up with a completely balanced, almost a perfect triangle there, and completely balanced value. So what you're really looking for is, once you get an early high established and an early low established, anything that goes and breaks these, a failure to continue, you can then play back. So you're looking at this area to then play back to the middle, this area to play back. You're looking at anything that starts coming down to these lows again. Equally, that little spike towards the top of value. So that gets you towards the top of the previous day's value. Little spike up, these spikes down. The hard bit in terms of the rotation within value is you will end up with situations where you feel that the opportunity to sell is perhaps here, and the market will then deviate higher. So you have to look at it as a range of prices to sell within, and your stops really have got to be waiting to see established trade outside of value. And if you don't get that, then there's no reason to get out of the trade. That's what makes it hard, because you can end up with what is naturally a reasonably slow moving day and having to trade and sit offside for maybe 10-15 minutes before we then roll only a small distance back down into the middle of range. But that's what's happening. As you try and balance value, you get this two-way trade. People essentially are moving their orders closer and closer together. This is why you get a trade concentrated in the middle, as more and more people come in to trade around this area, realizing that it's hard to get filled at the extremes. It's much easier to get filled anywhere inside of value on this day, which are the two red lines. It's easy to get filled. You look at the amount of candles in there, the amount of time, volume put in there, it makes it very, very easy to get filled. So, as a slight step on from this, I think the most obvious way of looking at these types of things, and the most obvious direct trade, and the situation where you can use the edges of value as tradable reaction points, is what I call a poor value area. So this is different to a broken value area, a sort of day that has got multiple perhaps single prints and dips and troughs in volume as it moves higher or lower, but instead a day that has exhibited complete uncertainty. And what this does is it forms a completely flat-edged profile. You end up, in terms of time, a very flat edge. In terms of volume, an almost entirely flat edge. What you have is a profile where multiple points could very easily be the VPOC. You know, as the day trades through, you may well have seen the VPOC here and here and here and here throughout the day, and it's just a matter of maybe another 100 lots, and perhaps this would now be the VPOC, another 100, this would maybe now be the VPOC, and it could fluctuate and move very easily. What that shows you is people clearly aren't sure where value is. If the perceived best price to trade at, the VPOC, can jump around throughout the day, clearly no one's really too sure where value is. For that reason, we need to repair this, and I'll talk about the concept of repair in a moment. These scenarios are much more visible in terms of volume than they are necessarily in time, and this is partly a symptom of, like I said previously, overnight markets now give you situations where you can spend a long time in an area without necessarily doing any volume. From a volume perspective, the complete uncertainty of where exactly to trade makes this much easier to trade. So, you've got indecisive trade here, and we're going to repair this. And I'll talk about the concept of repair in a moment. Quite simply, until value is established and we know what the fair price is to trade at, the market is going to fluctuate. And again, like I talked about on the previous slide, we're going to end up with a situation where the only obvious place to sell is the top of value, and the only obvious place to buy is the bottom of value. As a result, once inside, you can then look to try and play this to the upside. As you reach the extreme, you can then look to play it down. So you have to think about this in terms of where you're starting the day off. If you're starting the day off outside of value, as we see in this example, we open down here and then trade up through value. The way to be looking at this is once you're inside value, you can then play the move up. So look for a long to move all the way through value, and then a reactive sell from the top of value to rotate back, in this case, more towards the middle of the range. Yes, it does drop all the way back. Can you expect that? Not necessarily. The reason being, and this is all about thinking about what the profile is potentially going to look like at the end of the day. If your expectation is that we're going to balance this out, this implies that you're going to have a value area that, if I draw it very crudely, is going to look like that in this zone. For that to happen, where's the most trade going to be? Somewhere in the middle. As such, if you bought it on the movement inside of value and try and play it towards the top, the reaction from the top, you can then look for a trade back towards the middle. Like we talked about with ranges, market will not necessarily trade from the top to the bottom of the range, up and down. It may well trade here, establish value up here for a period, and then down here, and then cross it. So if you're selling the reaction from the top, it's very hard to have conviction that you're going to get in all the way back down. People looking to buy will have naturally moved their bids up within here because they've realised they can't get filled down here anymore and the market's moving higher, which is also what's going to prevent the drop going so cleanly all the way back through. So you've got to think about it in terms of where you're starting off. Equally, if you start off in the middle, so if we'd open here, you've then got to look at this as a reaction and a reaction and try and play it back towards the middle. What you don't want to be doing is trading in the middle. Because if the market is going to trade across that price, and this is where I think sometimes there's confusion. The market's going to trade across that price. That's the easiest price to trade and the fairest price to trade. But what that implies is that if most people want to trade at that price, the movement away from it could be either direction. A movement up can get dragged back and a movement down can get dragged back. So trading at the VPOC and trading as it develops the middle of the range, you're putting yourself in a situation where the market could go anywhere from there. Whereas if you're trying to trade at the extremes, you're playing it back to the point where most people are happy to trade, which implies if you're selling it up here, you're selling the point where people don't want to trade, looking for the market to go back to where people do want to trade, which means you're going to get pulled back on side. Whereas trading where everybody wants to trade, it can move either way from here and is unlikely to be able to sustain a movement. So one, you put yourself in a situation where you don't know whether you're going to be right or wrong very easily. And two, even if you are right, you're not likely to be right for very long before the market comes straight back to you. And that's why you don't really want to be in the middle of a developing value area. Right, little talk about trade then, and how things repair. Now, this is one example, and when we look at a poor high or a ledge, we'll talk about repair in a slightly different way. But the first way of thinking about repair is that any area where it is unclear that there is any value, so a market that lacks value, so an area with no volume, an area of a poor value area, this could also be an area that we've never traded before, or an area where the market has been stopped here. We don't know what people's perception of value is above. So the question of repair is about trading into the area where it is unclear where value is, and then at that point you're looking for a responsive trade to work out how the market is going to repair an area. Now, repair doesn't have to happen in the same way every time. A market can repair a reference, and we'll talk about this with the poor highs, by trading through that point. If, let's say, you have a bad high up here and that needs to be repaired, the market can trade through and trade straight the way back. This is repaired it because we've now found out that there are no more buyers up here, and we'll talk about that a little bit more in as we go forward. But what needs to happen, essentially, if nobody's sure where value is, sellers are going to try and sell at the highest prices. If they were happy to sell down here, great. But once they realise that there are sufficient buyers to overwhelm the sellers here, sellers are just going to step out of the way. Because if you don't know where value is in here, how do you decide what price to sell at? So as the market moves up, sellers are going to get out of the way until you get a situation where people feel it's moved far enough that they can now have a go at selling. Point two. At these points, then you will start to get some responsive trade. Sellers come back in, and like we looked at previously, where you have the sideways range, price discovery, sideways range, this sort of responsive action, you get the same thing here. You get responsive action at point two, you then get responsive action at point three, because this is where buyers gained control. If you think back to a switch trade that we talked about in the first week, similar kind of concept. A level is not just where there was previously resistance or support, but it's also the point where control is gained. Buyers gain control here as they drive the market into an area lacking value. And as you come back down there, you then get reaction and responsive trade to that. This limits the downside, and this is what repairs this area. So imagine this is a poor value area in here. The market then trades up, finds sellers at the top, back down we find buyers at the bottom, and as trade goes onwards, the auctioning process begins, which drives the market tighter and tighter and tighter and forms a very, very clear VPOC down the middle, number 6. That's essentially what was happening in that previous example where I showed you that trading cable up and down within the wide value area. So that's the idea of repair. I'll talk to you about this a little bit more as we go forward, but the idea is simply that any reference that is not showing balance, we need to find out if there are traders willing to trade in that area. This could have repaired by trading up here, finding responsive selling, dropping back down, not getting responsive buying, falling back down here. It's repaired it because what we found out is that there are not sufficient buyers to keep this going, and there are also not sufficient buyers even on a pullback. Sellers have completed them, or buyers complete the move up by running into sellers, and the market then comes back down. So, how does this relate to a poor value area? And this is what we're going to look at now. What we've got here, this is another example in the pound, this one, and I'll give you a different example in the bund in a moment as well. Here's your poor value area, very, very wide. Now, this is on the chart, the 2 blue lines are the poor value area. And you can see a bit like that previous one that we looked at. You've had a day here, so you've had one day up, followed by another day where we sell off, trade down. And you might look at that and think, well, that's a pretty clearly directional day. The problem is, what happens in here to create this poor value area? You get 3 attempts down here, which form a low. You then trade across it a couple of times, and within this, particularly here, you get this 4 hours of up, down, up, down, up, down trade. And that's what creates the poor value area. You can see where you might expect to get single prints, we don't. We trade all the way up and down this zone, and that's ultimately the problem and what creates the poor value area. As a result then, you're looking for the market to trade through. So having done this and sold off the next day, which is this move here, and balanced and created a kind of pennant low, market starts to rotate back up. So you can be looking at this with the view that if you can get inside of value here, above that VPOC, then you can look to try and trade all the way back up. Now, because this is a pretty wide value area, you end up with this situation where the market trades up and then balances back. So we end up with two-way trade, and we start to bring value up into here. We've not completed it, and we've not found out what happens when you reach the extreme of value. What happens up at these prices? Do you find any sellers up here? Remember, as a seller, you're probably still looking at this thinking, well, that's the extreme of value, so I fancy I could still sell there. So the next day, you're then looking at it from the point of view of being able to say, okay, we can use the top of value again, any further movement up, so a continuation of this move, further move up, top of value, reaction, market can then come back down and start to balance this out. So if we go and look at this in terms of actual execution, this is what happens. You've got the value area is the red just in here. This was the first day of starting to move inside of value, and then you get the breakout move. Fast breakout, hits the top of value and reacts. The first kind of idea on a trade like this is you sell it at the top of value, straight the way back to clear previous reference points, resistance, resistance, resistance. There's your trade, in, out. And that's going to give you around about 35 ticks for a very, very limited risk. Your risk can go just above that little high there. That's going to give you about 35 ticks for about 5 ticks worth of risk. Nice, simple, reactive trade. Now, at that point, the job is essentially done. We found out that there's no continuation selling at the top of value, and the market has fallen back inside the previous day's value area. So rather than it balancing entirely across it, we've found out that actually the repair is happening by establishing value in this zone here, all the way across there, and that's where value is now accepted, not towards the top of range. After that, you then get a move away from this value area as well, which is this move back down, and we then start once more to repair the next area of low volume inside the blue box, and we get trade reaction from both sides. This is a different type of repair. It's not a poor value area. This is a filling in of low volume. Similar kind of concept though, like we looked at with that first quality of value area idea. This is a situation where you run into a low volume zone, and we then start to fill that out, because again, as a buyer, if the market's not going to stop at the top and use the low volume as support, the buyers are then going to move their bids down and try and buy from the bottom, this high down to that VPOC. That's going to become the extreme of your day. So it starts to explain how you get these ranges formed, and the ranges get formed because people are looking to try and establish value in certain areas. Another quick little example, we'll look at again at the execution of this. And as we move through, I'm going to come back to this in terms of looking at these kind of ideas from the perspective of how you take certain trades on and where the greatest value is within a trade. The greatest value is not necessarily always to buy the low and get out of the high. What you're trying to do is you're trying to find the bit of the trade that you can say with the greatest confidence is going to work. So, again, nice simple poor value area, 62 to 82 once more. That's these couple of red lines just here. So, the expectation is, once again, that we are going to trade up and down within this area. And in doing so, you're then looking for any movement inside value to move through as one trade, and then any move through value to create a reaction from the top and roll back down, trade 2. Potentially, put in simple terms, and this is how you need to think about these things. As you go into this, you can go into this day, seeing that we're opening below value down here, at least with one trade already in mind. And that one trade is that if you can get above 62, your plan is to trade up, cut and reverse, and trade back down. And that's one plan. So that can sit there all day. It may not get inside value, may not give you that trade. That plan rolls over, and you still got this idea that there is 20 ticks up and a reaction probably of about 10 ticks back into the middle of range. Trade's done. That's what you can be looking for. And that trade sits with you, and this is the kind of way to use a profile to think about things, that you know it's there, you know you're ready for this type of trade. So, we get the situation. You get the move inside of value. One little skip up, and then we pull back, and you get the chance of a passive entry. Yes, it deviates a few ticks below value. But this falls back to a point where we've seen trade established there, late on in the day, trade established at 50, 57, 58, yesterday as well. It's also the bottom of a previous day's low over here. So you can see why this is a significant point. So it's about combining then the bottom of value with other reference points. You've now got yourself a clear passive entry. You've got a stop just below the open, which gives you around about a 5-tick stop. And you've got a simple trade, or a simple trade plan at least, that you can trade it all the way through here. You're not expecting a great deal of resistance because we've been trading through to find the sellers likely at the top of this poor value area. As a result, you can then cut and reverse at the top, and it's what I call a reaction scalp trade. The reaction scalp trade is the idea that once you hit this point, you should see buyers run out because you hit that reference, and you see sellers come in. Buyers take profit, new sellers come in to sell, market then gets drifted back down or rotates back down. As that happens, that gives you the move back down into the middle of range, back down onto this previous high for your reference point, you can exit the trade. This way, you take yourself 5 ticks of risk here, you take yourself about 3 or 4 ticks of risk here, and you manage to extract 30 ticks out of that trade. That's the way that you're looking to try and play these poor value areas. Okay, next up, so moving away from value areas as such, and looking now at what we call a high volume or low volume node, high volume, low volume zone. So difference being specific price versus a general area. And I'll talk about the little diagrams with balls on it. It's not a physics lesson. We'll talk about that in a little moment. Now, again, to try and debunk the generalizations that go with profile and the kind of simple method of teaching, and to explore this and to ask yourself, well, what exactly does this really mean in terms of practical trading implications? Because I think often there's this concept that something should happen, and so therefore that implies a way of trading. Now, often the converse is applicable with profile. So bear with me and I'll talk you through this. The general concept, as we talked about previously, is markets get attracted to high volume and rejected by low volume. That's the simple takeaway, if you will. Now, that's true in their creation, but not necessarily thereafter. So once you've created an area of high volume, as we saw with a very tight, well-balanced value area, a market doesn't have to spend any time there. And so whilst the market is attracted to high volume in creating it, once away from high volume, it can then move through it quite comfortably. And so the implication is therefore that once high volume is created, the market will no longer spend time there, which implies one of two things. You will either get to it and move away back where you came from, or you will get to it and move very quickly and cleanly through it. So yes, you get attraction too, but it doesn't mean you stay there. Whereas I think that's the first kind of assumed implication. Likewise, with a low volume node or low volume area, the assumption is that the market is rejected. Now, in its creation, the market does reject that zone. It doesn't spend any time there. So to create an area of low volume, what has to happen is, let's say you're seeing a market trade higher. You'll get an area of low volume, a volume at price, as the market moves up. And the reason for that is that the price moves quickly. So it doesn't spend any time at any price. You don't get a two-way auction. The market trades up, 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 up. So what happens is whoever's sitting on the offer, say you've got 50, 50, 50, 50 on the offer, a buyer will come in and go bang, 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 bang through all of them. The buyer won't buy and wait for somebody to come back and counter sell to them. It will just be take that price out, not finished, buy the next price, buy the next price, buy the next price. And this is a rejection of prices. The typical kind of view of rejection is the market trades up and back down, but you can reject by not spending time there. So the rejection is to do with the amount of time and volume spent there. It's rejecting a willingness to trade at those prices. That's essentially what you call a price discovery mode. Market trades through until it discovers two-way prices. One side is completely in control. That's the simple assumption. But then if we look at this from the point of view of what happens when you revisit these zones, then you get a different scenario. So let's start with a high volume node. With a high volume node, what will happen is, yes, the market, if it's away from it, can get attracted back to it. Once it gets there, one of two things are going to happen, neither of which imply a long time at the highest volume point. And this is why I've drawn it as a kind of ball rolling up a hill. Imagine if you push a ball and it rolls up a hill, you think about it as a game of golf. You try and putt into a hole at the top of a hill. If you hit it too hard, it's going to go up the hill, slow down and accelerate down the other side. Or you hit it too soft, it's going to go up the hill, slow down at the top, not have the momentum to reach the hole and roll back to where it came from. In both situations, the time spent at the top, unless the ball falls in the hole, if we're using a golf analogy, will be very small. It will either get there and then slowly and accelerate back down, or it will get there, slow down and then accelerate down this side. Whichever way you look at it, time is not spent here. So yes, it gets attracted to it, but it won't spend any great deal of time when it gets there. In terms of a trade, what this typically means is if this is your high volume node, the market will come down to it and bounce away, or we will come down to it and trade straight the way through. Neither situation spend any time here. You will spend more time filling out either side, so you'll spend more time and volume below it down here, whoops, or above it up here. And the converse is true of a low volume zone. With a low volume zone, yes, this does imply that a rejection has taken place. The market has moved away from prices quickly. So therefore, very little time has been spent there. As such, the market will use these zones as a point to react from. If, let's say, in that previous example I talked about, buyers have taken control and driven price higher, a new buyer is going to look and think, right, well, all of the people who were selling lower down got eaten up very quickly. They're not going to come in and sell again. As a seller, equally, if the market is just driven straight up here and all of the sellers have got taken out very easily, you're not going to come and sell in here because the last people who sold in here, buyers just bought straight off them. So sellers aren't going to come in down here. Sellers are instead going to go, okay, well, let's put our offers higher up. Buyers, realizing that the last time we were in this zone, they stood no chance of buying because everybody else rushed to buy, now realize that you're going to have to move your bids up. So they move their bids to the top above the low volume zone, which means that you then create this low volume like that. So you end up with low volume in the middle, and buyers come in from here looking for this type of movement, and they buy from the top. The last chance for a buyer is the middle, and if they can't get filled there, they're going to move all of their bids down to the bottom. The last point where buyers actually overwhelmed sellers. And this acts a bit like a ball falling into a gradual dip. If you fall into the low volume node, so fall into what we call a single print vacuum, and I'll give you some examples of this in a moment, what will happen is the market will then rotate from side to side. So a ball falling into a dip is gradually going to trade up and down and up and down until it spends more and more time in the middle. So this way, low volume zones actually entice time and volume into them and get trapped. Yeah, it will trap the market. A high volume zone will accelerate the market and will move it away from that area quickly. So that's the way, in practical terms, as you approach these things, you can then look for reaction. Their creation is the opposite. It will take time to build this amount of volume in one place. It will take very little time to move away from an area that has got low volume. But once you're back to them, you will spend no time here, you will spend lots of time here. That's the way you want to think about these things. So let's go and have a look at a couple of examples. Here what we have is a high volume node. So try and talk through what's happening. Your VPOC on the day, so we're using the VPOC as your high volume node, which clearly has appeared over here as well as over here. So there's a lot of acceptance at these prices, around about 43, 75 to 73. Lots of acceptance there. So the market trades down here and we get stuck down there for a fair period of time on this day. These are 5-minute charts up here with the day's profiles over them. Next day then, we move away. So we open away from this area of high volume. And like I was saying, the market's not going to spend time at the point with the high volume. So you're looking for one of two things. We're either going to come down here and react and bounce away, or we're going to come down and move through. And that's exactly what happens. After establishing value a little bit higher early on in the day, the market then drives straight down and straight through, all in one. After that, volume can be built up either side. And this is what's happening here. Volume gets built below the previous area of high volume. So if you push these two profiles together, rather than having high volume with nothing below it, this bit of low volume, this sort of high volume here is going to fit in the gap and fill this out, creating a more balanced, rounded profile in total. So that's why we then spend time below, and we then use this as a resistance again, which happens just here. So you get the quick sweep through, either, and the way you want to think about this is if everyone's happy trading here, either buyers are going to retain their comfort in trading there, the market comes down, buyers will step in at that price, which is what will stop the market going lower, or you're going to get there and sellers come in at this price and sell it, buyers step out of the way, and you get the sweep through and sellers continue to sell at that price. Whichever way, you won't get a great deal of time spent there, and that's what happens. Quick sweep through, uses it as resistance, market then falls away from there. Essentially, the way to think about it, the market was balanced down here. So the onus is on the buyers to react when you get there. Are the buyers going to come in and show the same strength that they did down here to stop it going any lower? The answer, no. Get a quick sweep through, and that's what then allows volume to build lower down. Sellers then start to realize that there's no buyers here. They then start to sell from that point, which prevents any further bounce back to it or above it, which then means that trade naturally gravitates lower from there. You will also hear, when you read about profile, talk about a market is not going to be able to sustain a move without testing VPOCs back, and this makes sense. If everybody's happy with trade here, then the assumption is if we get a gap up, we haven't found out whether people were willing to trade away from this. What we've found out is there is perhaps a piece of news or a correlated market move that has dragged us up there. Are people still willing to trade here? And this is why you will often see this repair, if you will, of a market trading back to a previous VPOC. It's to find out if there are buyers. And what I mean by that, and it's not because people are sitting there going, I want to find out if there's buyers, let's sell it. What happens, the mechanics of what's going on, is this is where buyers were happy. Both sides were happy here. So sellers are happy to sell above. Market gets pulled back down. This is what I mean by finding out if there are buyers. If there are buyers here, they're going to come back in because this is where they were happy to buy from previously. They were happy to trade at these prices or lower. The fact that now having seen price higher suggests that you're going to have to move your bids up. Where's logical to move them to? The fairest price to trade previously. So now you find out that there are buyers. Tick. There's your reaction. Down to previous VPOC and bounce away. Little time spent down there, market moves away, all good. There's your reaction. But the next day, we come down and trade that VPOC again. We keep on touching on it and bouncing away, bouncing away, bouncing away. So rather than seeing the straight sweep through, instead what we're getting here the next day is after a day where volume trades above the VPOC here, volume equally builds above the VPOC again. You're not expecting a great deal of time at it, which is why it's constantly hit, bounce away, hit, bounce away, hit, bounce away. So whilst you've had multiple touches, you've not had a great deal of actual time there. Imagine seeing a ball bounce on the floor. How much time does it actually spend in contact with the floor? Very little. Even if it bounces, 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 it won't sit on the floor for a great deal of time. As soon as it gets there and does sit there, then you get the rush through, which is what happens here, and you finally get the sweep through. So you can either have the break through a high volume with trade above it. So if you have this as your high volume, you will either trade above and through, or you will trade through and back. But either way, you won't put a great deal of trade actually on that price. Most of the trade will be above or below. and the time on the price is limited, and we go through it, or we go to it and then through it. Or in the previous example, to it and bounce away, which is what happens here. And this applies not just on the previous VPOCs, this can apply on a high volume node that is established over a week-long basis, over a month-long basis. So you then have these cumulative volume profiles as well. So what I've got here, this is an example in oil. You've got a very, very high volume node created on this week. So this is the entire week's profile. Really, really clear high volume node here. What we then have is a steady period of a couple of weeks where we sell off. So we have this sort of chop volatility on a gap up, and then the market steadily drifts lower, drifts back to where it came from, attracted back. In terms of reaction then, this provides a great point to target. You've got trade opportunity to play down out of this little range. Target, you've got previous VPOC down there. You're looking for reaction on it. Market drops down, bang, on it and bounce away. Nice and easy. That's what we're looking for here. And that's what you get. First time reaction, ping, ping, back up we go. And the next time you go down there, because we've now traded it and seen that reaction, the second time you can look for it to break, which is what you then get here. And then we use it as a resistance. So make sure that any previous, what we would call a naked VPOC, an untraded VPOC, you look at in the context of, okay, if we're coming from a distance away, yes, we can go back there. And you're looking for, and when we talked about this previously in terms of a decision when you get to a point, as you get there, ask yourself, am I looking for this to hit and bounce, or am I looking for it to trade down and through? Doesn't matter which you decide, as long as you're looking at it and saying, right, if I think this is going to bounce, what do I want to see? What you want to see is it straight there nice and quick and almost immediately react. You don't want to see it sitting just around it. The longer time it spends sitting just above the VPOC or high volume node, the more likely that it is going to fall through. As people realize that and think about, if you fall to a level, people buy. If the market doesn't bounce away quickly, the people who just bought on the level then become uncertain. They don't fancy holding on to this. And if it starts to drop through, they're all going to run for the exit, which creates then the rush through. So if you're looking for the bounce, you want to see it react quickly. If you're looking for it to go through, if it gets pinned on it, can't bounce away, good. That's what you're after. Ideally, if you're short going into it, you want to see it go straight through and then use it as a resistance. That way you can place your stop above, get your stop above here, and then you can hold on to it on that pullback and then try and play onwards for the next leg towards the downside. And here's almost an identical scenario. Another one in oil, completely different time of year. Same principle. Week-long high volume node established, market trades away this time rather than gaps away. We trade sideways in a range, drop out the range, fail to go lower. So this creates a little area of high volume on this day, just below previous lows. You come into this and we sweep through the high volume zone. So this is just a short-term one created on a daily, but look at where the continuation goes to. Bang on that high volume node from 2 weeks ago. This is in fact the exact, or almost a carbon copy trade, almost exactly a year later. If you look at the dates, this gap up is on the 15th of December. This move up is on the 15th of December. And you then get the pullback to the level. In this example, pulls back on the 26th. In this example, on the 30th. I'm not saying that you're going to be able to get it date-wise exactly the same every year, but it's interesting to see that this sequence of events happens almost identically a year later. We'll talk about this when we talk about pattern bridging much later on in trade development. But concept is, there's your high volume area to sweep through, or high volume zone. Sweep through, fast break, reaction the first time, can't get back into the high volume, and then sweep through a second time and reaction once again. That's how you're looking at these. You're not expecting time spent there. That's the big lesson to take, but that implies either hit and bounce or hit and through. Right, low volume zones then. So areas where it's quite simply, you see it in terms of time and volume. You're looking at a single print or what we call a vacuum. And the reason it's called a vacuum is that if you get inside it, you can get sucked through. And I'll talk about this in just a moment. What's happening then to create this is initiative action. In this example just here, initiative has been taken, which has driven the market lower. That has created an area of low volume. That has put one single print across that area, so just a B print takes you straight through, no more trade there, and trade establishes lower, and you in fact get what I would call a very bad looking ledge at that point. So that's your vacuum or single print. That's your initiative action. This is somebody taking complete control, sellers taking control of the market. Now, we talked about price being an advert to trade previously. In order for this initiative to sustain movement, you need to see volume accumulating lower, which is then what happens. You get this reactive trade, and you are going to have to wait for another print. You can't tell that there's a single print until you get another print. So once you get a C print, which bounces as high as there, now you can see where your single prints run from, here to here. You can then use this throughout the rest of the day as a resistance. The assumption is the market won't move back inside the area that it drove through because sellers completely had control there. And now you're finding the point where buyers are able to bounce back to, but can go no further, where basically they run into responsive sellers who are then essentially moving their offers from here, where they couldn't get filled, to down here. This creates the vacuum. And you can assume this is going to create an area of resistance. Until that is, you move back inside. And this is why it's called a vacuum, because once inside, if sellers had complete control here, and then move their offers down to here, what you're going to end up with is a situation that once you move inside here, sellers are going to get out of the way. Because the point where they really took control is up here. So if you're in a situation where the market drove straight through these prices, there are no levels, there are no reference points in here. So the only reference point you have is where we were trading previously, and this is what's then going to allow this to get sucked straight the way back through that zone. So as such, you can look at this as a reference point that is going to go back nice and quick once you get back inside of it. And this is where you end up with that ball falling into a trough idea. That as soon as you move back up here, if sellers put their offers from here to here, the market will move up, you find sellers come in, and that's then going to create reaction, which creates this type of sideways action and fills in what I would call a cave. You can look at this if you trade through to be the top of the single prints all the way up to the VPOC, where the volume starts to peak up again, and use the VPOC then as your reaction point for this same type of two-directional trade. One thing worth looking at is whether you have a shift in value. In this example, value doesn't shift, which does put the single prints in danger for the rest of the day. It could well be that they fill within the day because the market has not managed to shift value down with that movement. Advert to trade concept. Without the shift in value, this is a slightly less sustainable move. You can use the single prints and the low volume and use them in combination the next day as well to provide you with resistance. So you can assume this resistance to last until the market trades into and through them. So this is how these types of things get created, but also how you can then go about trading them. So what we've got here then is a situation where you get this very quick initiative move higher. Nice and quick move. And in terms of volume, I've got this broken up over the 2 days. This creates your low volume. This is Euro stocks. Now, for anybody looking at Euro stocks is pretty thick on the bids and offers. And this was also before it went to a half tick. So it moved to a half tick at the back end of 2021. Just before that, you would see 1,500 lots on every single price. So in this movement, where there is a distinct lack of volume, or lack of volume here, initiative here, you have got a number of prices, 1, 2, 3, 4, 5 prices, none of which have got more than 2,500 lots on. One of them has got less than 1,000. This implies a market that has traded straight the way through without any two direction. Now, in the first instance, this will have also applied to these prices as well, because you can see this candle trades straight up. So support will initially come right at the top, where you finally get two directional trade. So this is what will create the support. So you can look at these low volume zones in two ways. You can first look for the support right at the top of them. You've then also got support from the middle, from the point where you have the lowest volume. So that 986 provides you the support. That comes, the market doesn't trade into that, it trades the tick above and stops. Therefore, you do end up with volume starting to increase at the prices above there, whereas you've seen also, to get down there, we've now traded this 2,000 lots traded at these three prices is a cumulative of this move and this move together. And you still see just how little volume is traded there. So we're not willing to trade at these prices. Market rejects from the low volume again. It's only then once you can trade through this that you will then start to fill this out. But this can be something to expect over the coming days, that any fall through this point where you've got 986 lots, fall back through 34.65, the level, then you can then trade up and down within that range. Without a profile, it's also not so easy or clear to define where markets can get stopped or where the acceleration points can come from. So if we're going to have a little look at this, What we've got here then is a market that has put in a set of single prints up here. So this is the profile beforehand. Your single prints run from 90 at the top down to 36 at the bottom, which is this little zone here. In fact, so I put 90, it actually runs from 88. So 88 to 36. That's these two red lines just in here. Now, if you're looking at this from the point of view of a candlestick, the easy trade to look for is the previous low, which is 63.05. But to create the single prints, the market actually traded just below this previously, in this move just here, and then the acceleration comes. And what the single prints or the vacuum is showing you is where the market had the greatest strength, where it was able to drive the most. And so what's then happened is you can use those single prints to identify that point. There's your low volume in the middle here. And if we look at it on a 1 minute in terms of the move back through this zone, this is what identifies those reference points, or identifies the high of this move. Here goes your move up. First time we hit the bottom of single print, you get reaction. It's not huge, but this is only on a 1 minute chart, and you get a reaction from 33, and this gives you a pullback at least as far as 10. So you get a 20 to 25 tick whip back on that level. Once through, then you get the move straight up, straight through to 88. And again, reaction straight back from there. 88 back down towards the middle of the range, which gives you it back all the way to 60. Another 20 to 25 ticks. Hit, react. And the market then starts to spend time in the upper end of that vacuum. You start to spend time up here and begins to fill this in. After a while, you would then be looking for it to rotate back down towards the 36 and then try and trade this entire zone out. If it doesn't, and it manages to move through here, leaving low volume again, this shows not only a rejection to the downside, but a rejection back up, and indicates to you that this is an area the market really does not want to trade. As such, it now flips over and becomes a support the other way. So yes, you do have that falling into the cave or falling into a trough bull concept, but if you can get through these zones, the market is not going to hang around there, and the market is then going to be able to drive on from these points. What we've looked at so far is markets moving to create the low volume, or markets moving back through the low volume. So coming from away, back inside, and then moving through. So that kind of vacuuming effect that you get sucked up through it. Basically from high volume to high volume, you get sucked through and then establish in the middle. But if you open inside of an area of low volume, illustrated here, and I've purposely not picked a kind of absolutely perfect cave, as I would call it, to illustrate that if you open up in the middle, and again, an area where it's not clear where value is, you've had what was a VPOC, then becomes a VPOC at much higher prices. So essentially, you have a VPOC here, followed by a VPOC here, with fast trade up there, and then back down, a low volume trade into the middle of this range. So an attempt to fill that out anyway. What you then look for the next day, if we've opened inside of this low volume, is a bit like a poor value area, reaction from each side, and then building volume to fill the cave. So this is what you're after, and it's a reasonably simple trade. It's what I call a cave fill trade. You can almost come into this day and say to yourself, right, I'm going to put an offer there, I'm going to put a bid there, I'm going to put a stop inside the single prints, I'm going to put a stop above the high, and leave it. And the assumption is it will trade between the two. And that is a reasonably common thing to be looking for. What you have to think about is what this means in terms of how the day plays out. It generally results in a reasonably limited day. But the implication is, if you're opening in the middle, you're going to trade between the areas of high volume. Again, high volume attracts price, the market will bounce up and down in those zones, fill that in, and give you opportunities to play reversal trade back in towards the middle of the range. Right then, let's go and have a look at the sequence of how these things get created. What exactly happens to create these low volumes, high volumes? So how they get created, the reaction to them, the time spent within them, and then the movement away from them. So this is a sequence in the S&P going into the back end of 2021, so December 2021. What we end up with here then is three profiles, which is these 3 days. These are all purely cash session S&Ps. So we're not looking at the overnight session, pure cash session. And what you have here, first day, and we'll move through each day in turn and what exactly that implies the next day. So this is a little introduction to what I call mapping, and we're going to spend much more time on looking at the stepped process of mapping as we go through this week. what we're looking at here then, first day, value gets established lower. Market's quite happy to trade down here. Not a great deal going on, reasonably stable, sideways action. As the day progresses, we then get a directional move. This is in fact a directional move created by news, which drives the S&P up and away from value, leaving an area of low volume here where the market is completely driven by buyers. We surge higher in this zone, which runs from around about 53 all the way up towards 76. Straight line move up. We use the top of that low volume as an area of support to give us that final leg. So that's the first day. This creates the low volume zone. It provides buyers with an area of support. It provides an area that potentially could be filled if we fall back into it, or is going to act constantly as a support. Now, take away everything else, what we know about value is market will get attracted back. What do we see down here? Value is left much lower. As such, you can look at this vacuum and think to yourself, I actually am more inclined to think we will trade through it than we will use it as support. Reason being, value is much lower. That's a kind of magnet sucking the market back down. So, first attempt, can we get inside it? No, it does provide some support. Now, the more time we can spend up here on this day, the more able we are to maintain value higher, which over the 2 days will allow this area to be seen as a rejection and an attempt to, and now a sort of base to move up. So there's the chance. The market needs to move up from here now. If it doesn't, the next time you fall in, you get the drag straight the way back through. We trade straight the way through 76 to 53 and time gets spent in the middle. Whereas the VPOC on this day, just here, bang in the middle of that previous area of low volume. So it fills that out. You can see it doing so just in here. So that's your low volume node. Taken away, high volume is created. There is still now a situation where you have a VPOC here and a VPOC there. This is now the new area where we can trade. So we trade in this zone. Here's your VPOC, the little purple line just down here. The next day we open, trade straight the way down it, straight the way through it. And we do then, because of the lack of continuation, actually get stuck in these areas. So as I suggested before that you will go to and react or move away, in this situation, because the straight through doesn't materialize into a further movement, this then gives you a situation where the market clearly is still willing to accept trade at these areas, at these prices. And in doing that, this then maintains price down here. We get one further leg or attempt to go lower, fails, back up we go, and we end up using this low volume zone, which is now not a low volume zone because of the filling out, as a resistance again. The reference is created. That's what's significant. That the reference around these prices, even though it has now filled out, we've reacted there, we've reacted. This becomes an area of resistance. And so this becomes a much more just simple technical reference that we now find resistance there, react to it, and back off we come, which is giving us that move all the way back down. And where do we go back to? Sucked back towards value. So that's giving you the concept of how high volume and low volume get repaired, how they get filled in, how a market is going to react to them. What you want to be thinking about with each of these concepts is, right, what does this mean in terms of how I'm going to trade? What am I going to do next time I see this area of high volume? How am I going to approach it? What do I want to see when we get there? So you're providing yourself with a framework of a kind of expectation, and then being able to say, okay, well, what happens when it trades straight through? What happens when it bounces straight from? They're the kind of questions that you need to be thinking about and asking yourself in these situations. Okay, final concept then. So we talked about repair, we've talked about the significance and quality of value areas. Next concept we're going to touch on is the idea of, is a move complete or incomplete? And I will explain why I've got a picture of lemmings jumping off a cliff, shown in just a moment. As we talked about with auction theory, you don't find the end of the move until the last buyer or seller is found. So for a move to complete, what we need to see is a tail. You need to see volume taper off. You need to see a running out of buyers. Less and less time will be spent there, because as soon as you run out of buyers, you now have a load of sellers who need to move their orders lower if they want to get filled. So we don't see a great deal of time. So if you've had a move up, once the tail's created, the last buyer has been found, this implies the move has been completed. Now, lemmings don't actually like the computer game, and apologies if nobody's seen the computer game, but go and have a look. It was a classic game from the 1990s. I was around when it came out, which shows my age. where you had a string of lemmings which you had to protect because they would jump off a cliff if it's there and die. Now, if the lemmings were slightly smart and there was a never-ending queue of them, what would happen is when the cliff edge is approached, one of them finds it and falls off. And that's the indication that that's the end of the line. Now, that's what happens with a tail. You march up to the end of the move. You don't know where it is. So if you're kind of blindfolded, if you think about it, march up to the end. When somebody falls off the edge, you know where the end is. You know that that's been established. That's the end of the move. Whereas with a ledge or a bad high, you don't. You don't find the end of the move. And instead, what happens is the market is forcibly stopped. So let's say a market rises up, somebody comes and sells, and sells, and sells. Now, you've not found the final buyer, because what's happened there is you've got multiple people willing to buy, and somebody comes in and goes, okay, you can have it at the price you want. Imagine an auction to buy something, an auction to buy a watch, and there's still 10 hands up in the auction. Rather than waiting to find out the highest price anyone will go to, somebody decides, actually, I've got 10 watches to sell, all of you can have one for the price that you've just bid. What this does is this doesn't show you the true value. This shows you that somebody has a greater degree of willingness to sell than a willingness to find out how high the price can go. They're happy to take whatever they can get, rather than let the price keep on going. So what this is like, if you think of the lemmings example, is they're all marching towards the edge blindfolded, and somebody puts a wall in the way. No one's going to fall off the edge, so you don't know whether the end of the move is just behind the wall, move sideways, just behind the wall, or a mile behind the wall. So you don't know where the end of the move is. Whereas with a tail, you found the end of the move, and it's being shown to you. With a ledge, you don't know where it is. And so imagine once you've got this build-up of people one side of the wall, eventually the wall can break. And when it does break, you'll get this rush through. Now, if there's a rush through and the edge is right behind that, people rush through, fall off the edge, and that's the end of the move. Or they rush through and they keep on going until they find the new edge, the end of the move. And the thing is, you have to remember that nobody knows the end of the move until you found it. So you can't tell where the last buyer is going to be, unless you are the last buyer, in which case you buy the highest price and that's the end of the move. But nobody knows where that is. And it's only once you've been shown the end of the move with a tail that you can say, okay, that's over, that move is complete, and now we can go back in the other direction. Whereas with a ledge or a poor high, you have a situation where the market gets stopped, and at that point the move is currently over, but this has not shown you whether there is a willingness to keep on going, whether there are more buyers on a move up or more sellers on a move down. Only once you break the ledge can you find that out. So we're going to look at a few different examples of ledges, ledges or bad highs, and what happens as these moves get, or as we break through these points, and what the resultant move is. Right then, let's go and start by looking at what we call a tail, or some will refer to this as an excess. And there are different types of tails. We'll talk about this in a minute. What's happening is buyers or sellers have been drawn into the market, quite simply. So to create this tail down here, sellers have been drawn in. They keep on coming in to sell, somebody wants to sell, and they will keep going. As long as there's a bid there to sell to, they will sell and sell and sell and sell until you run out of people willing to sell. At this point, you run out of the ability to keep going. Buyers now have to counter, and they run in to start to buy, because they realise that if they've got bids below here, they're not getting filled. If you wanted to buy, and think of this as somebody who's going to scale in across multiple prices, they find it easy to buy from here, 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 nice and easy. They put their order in, they get filled. They put their order in, they get filled. They put their order in, they get filled. Slowly, they put their order in, they don't get filled, or they get part filled. This is now telling you the move is coming to an end. Buyers now realise that they can't get filled anymore and are going to have to move their bids up. At the same time, sellers also realise that there are no more sellers. So if you're confident selling because you think there's people behind you selling as well, and all of a sudden nobody comes in after you and sells, you know it's the end as well. This is what we call a buying tail. A tail where buyers have taken control and sent the market back up. What you're looking for is volume to taper off. What you don't want to see, and I'll give you an example immediately after this, of what I would call a bad tail. A tail where you actually have a significant amount of volume at the low. So it's not just about letters, it's about volume. If you do a load of volume at the extreme, this is essentially showing you a move that hasn't yet finished and could well keep on going. As a general rule, So over a period of time, what you're looking for, if you're on a directional move up, so thinking about how good a job is a move doing, until you get a tail, this move can't be deemed complete. So like seeing value consistently move higher suggests that the move can keep on going. A tail equally suggests, or a lack of tail also suggests that the move can keep on going. You've not found those last buyers. And so therefore, as soon as you get the tail, there's the end of the movement. That's what you're after. Now, you do get different types of tail. You can have what I call an initiative tail. This is a situation where you will have a market opens and then drives straight up and trades up here. So this creates a single print tail like this, but if you had the open here, this would be an initiative tail. That where the market's open, people have come to the conclusion that this is not a good price to be trading anymore and immediately show initiative and drive the market away from that point. So that's your initiative tail. Decision gets made quickly, value establishes somewhere else. Alternatively, you can get a responsive tail, something much more like this, where the market's opened up here, traded up here, and then traded down and back away. So a rejection of prices. What this shows you is it shows you where the limits are within the day. It shows you that the move has gone down, found that there are no more sellers, buyers come in, buying tail, and back up you go. So that's the difference in these two types of tail. What we're going to have a look at now is a few different examples, starting off with a bad tail. What you get in a bad tail is a situation like this. This is your move higher, this is another S&P example. Drive higher, all the volume gets jammed to the high. Now, if you didn't have this, we do have a distinct lack of volume on this move up and pretty much a single print. But in doing this move, this is the end of the day. People are still willing to trade at these prices, clearly, because of the volume done up here. So, this suggests that the auction hasn't completed. You've not run out of buyers because buyers have clearly been willing to trade up at these prices. So in doing that, this suggests that the move's not over and we can keep on going. Strength is still there. Going into the next day then, because the move's not over and we get a gap up, the sellers that sold down here are now in trouble because the market's gapped above them, and buyers have now got further reason to believe that this can keep on going, and this creates an initiative tail. Market opens and then drives again. This then drives price higher and shows you that essentially we're rejecting trade down here. There is no willingness to trade down here, and people seeing the price there see this as a great opportunity to buy, just as they would in a responsive tail. Market falls, buyers see this as a great opportunity to buy and run in and buy. Here, market actually rises, we get a gap, and buyers still perceive this as a good place to buy and rush in again. And that's what then drives this up. And this is that initiative driving the market higher. We then, on the back of this, establish value higher, which implies you now have a stronger market, moves value up over 2 days, leaves, if you combine these 2 days, an area of distinct low volume running from here to here. And this now acts as your low volume zone and acts as a support over the coming days. This, on the other hand, is what you would call a good tail. Here we have a sell-off. This is an example in gold. Gold sells off, 1 day down, another day down, value put towards the low of the range. That's a pretty decent, strong looking move. Value gets moved down, the move isn't yet complete, no tail. So, how's the move going to end? We need to find out if there are any more sellers down here. And what happens is we get some sideways trade. Here the market's been imbalanced, begins to balance, and like a previous example we looked at, market then starts to balance again. What we then get is a breakdown. So this is your drive away from balance. This is the chance to find out, have we got enough sellers to keep this move going, or are buyers now who clearly are happy to trade here and happy to trade here, are they going to view this as even better prices? And so therefore they're getting bargains, if you want to look at it like that. They get offered some bargains, they come in and rip the market straight back up. That gives you a good tail. You get a clear single print. We don't get a great deal of time below the previous low. So not only do you have a single print, there's a reference of that previous low as well, through and straight back. The volume tapers off. And when we look at order flow, I'm going to look at exactly what happens in these situations, because what you get is what I call a high-low volume reversal. And we'll talk about that when we look at order flow. It's a great way of being able to accurately finesse an entry very, very close to the low. You could end up buying it down here without having to wait for the single print to form. Once the single print forms, you'll confirm that you have found the low. Not only that, you're in very close to the low. but we'll touch on that when we look at order flow. So there's your single print. Lovely looking tail. That changes the complexion of the market. This changes your bias, and this basically says to you, you can now start buying. Whether that is as a longer term move to just buy as soon as you get back in range, stop below the low with the view of reversing the entire move, or whether it is a case of the next day when you consolidate and start to trade above the previous day's VPOC here, you can then play it up either as a passive trade to reach the top here, and that's your more day trade style, or as an aggressive day trade out of range looking for this move up towards 1807. They're the different ways that you can take the trade on, but the point being that as soon as you've seen this, your view for the rest of this day and your view for this day is that we're going higher, and you can then look for opportunities to buy, chances to get long to play for that continuation move. So that's essentially the end of the move and the beginning of a counter directional movement. Another example, this is a situation where you can maintain a trade. So that gold one, you'd already seen the direction established and market starts to balance, which kind of says to you the move is coming to an end, at least in the short term, and you're waiting for the next leg. Whereas here, you've got to move up in the pound, a trend type day, which is this day here. You get low volume, high volume, low volume, high volume, high volume. This continually moves the market up, but there is no tail. So in terms of a broader move, you're looking at this and think to yourself, this move's not over, there's more to come. So you can go into the next day, even on the back of that very clear imbalance move up, which ultimately was preceded by another imbalance move up, and try and buy again. You can use the single prints, the low volume node in the middle, as a reference to try and buy from. We've talked about this already. And that's what happens down here. You get the drop back down, and you can then try and buy. You get the move, and what you're looking for on a day like this, if you bought it from down here somewhere, you're looking for a break of the high. When that comes, this potentially is the next leg of the continuation. You're not looking at this thinking, I think there's a tail coming. What you're looking at is the potential for continuation here. So you're going to be watching this as we move higher, feeling reasonably confident about the move, looking for the market to keep on going. Now, when it puts in this quick move and straight the way back and volume tapers off very quickly, you can start looking at that and thinking, maybe this is over now, which is going to get you out of the trade. And that break of the previous high, which just comes in here at 131.11, i.e. the previous high, which is the X print, the Y print trades through and comes straight back down. Once you're back below the X print, that looks like it could be the end of the move. That's potentially your tail, which offers you the chance then to try and play the move back down, or if nothing else, says to you, get out of your long and wait for more information. What this also does is now opens up the possibility of the market going the other way. And you can now look at the leg towards the downside. What you end up with is an attempt from buyers to hold this up. So after the tail, market rolls back down and balances out, and we get this trade down here. So there's your tail, trades back down. The next day, we hold the low coming in here, which creates another day with no tail. No tail here either. You get 2 DPOs. You need at least 3 to call it a tail, and ideally you want to see a few more, particularly in the market that has got a greater range like the pound. So this says we can keep going, which therefore means the next day, a break of that low gives you the chance of a larger move down. We move down through this low, through this low, through the high volume, through the single print, straight down, and give us another tail down here. Now you've got that tail, the bias flips back. The fact that you've got a tail here and now a tail here suggests that this is a market that can't find enough sellers to go down and can't find enough buyers to go up. And that's the first indication that we're now starting to balance. And this is going to create further balance from this point. So that's how to kind of view the sequence of action when you're seeing these sort of tails as a move is growing. It tells you the move's over there, it tells you the scopes go down here, and very quickly tells you the move is over there. That now suggests that this is a market which is becoming balanced. The kind of sting has been taken out of it in terms of direction, and we're now going to rotate up and down within this range.